Hello, this is John Calverley, Chief Economist at Tricio Investment Advisors. In this short podcast, I want to present our Q3 Economic and Market Outlook, just published. We find it useful to analyze the outlook using scenarios. We find this helps clients think through their views better. And it's also important that portfolios are built in such a way that they can perform reasonably in all scenarios, of course, taking into account risk appetite. So in order to do this, we look at two drivers. We look at the outlook for COVID and the outlook for political cohesion. So one possibility is that COVID is tamed over the next 6 or 9 months, social distancing, track and trace, but then we get treatments and a vaccine arrives, at least by the first quarter or so of next year. Alternatively, COVID's going to stay a problem for much longer. Perhaps we get a second wave. Importantly, we don't get a vaccine, or at least not for a long time. But there's another driver, and that's what happens on the political front. If cohesion holds within countries, but also the international situation holds up, that's one thing. Alternatively, we could see a real breakdown between the US and China, perhaps within Europe, or perhaps something else as a result of the recession and crisis. So these two drivers give us 4 scenarios. If you look at the first one, there's steady recovery. This is our central scenario. We give it a 40% chance. In this, the recovery, which has been going on really since May, continues. We get that vaccine, and then probably by about the end of next year, the economy gets back to where it was at the end of last year. Still a very bad recession, the worst since the 1930s. High unemployment will last for quite a long time, well into 2022, 23. We're going to have a lot of bankruptcies, a lot of problems. But nevertheless, this is our best scenario. The second scenario is what we call the long slog. This is where the COVID is not tamed, the vaccine doesn't arise, and so the economy stays weaker for longer, with that potential for a second wave and a double dip for the economy. Third scenario is where the COVID is tamed, but you get political problems in some countries. So you get a very patchy recovery, with some places doing much better than others. And the fourth one is where COVID is not tamed and you get political problems. So this is, we call the depression scenario. It's really a worst outcome. So just looking at the two main scenarios, we give a 70% chance to these two combined. This is what it would look like approximately for the UK. So a steady recovery, you get a rise in the third quarter of this year as we come out of lockdown, and then basically a steady recovery over the next few quarters, get back to 2019 levels by the end of next year, and then continue on up. Alternatively, the long slog scenario, we see that little bounce that we're seeing at the moment, but then a second wave or a new lockdown, even new local lockdowns, people staying away from restaurants, pubs, etc. And it just is a much longer time to get back up to the 2019 levels. So what do these 4 scenarios mean for markets? Well, in the steady recovery scenario, I think we would see the rally that's been going on since late March continuing broadly. The recovery stocks would do particularly well once we really feel we can get past COVID, leave it behind with a vaccine. So recovery stocks would probably outperform growth stocks over that 1 to 2 year horizon. In the long slog scenario, though, I think the markets would quite likely go back and retest the March lows. It will be a very difficult environment. Probably growth stocks are going to outperform the recovery stocks, but it's going to be perhaps a rough ride all round. I don't think the March lows will be broken, and in fact, this could be another buying opportunity, but it's going to be a rough ride. In the patchy recovery scenario, scenario 3, it's going to be mixed by country, and this is where it's very important to diversify to avoid being caught too much. And finally, the depression scenario, this is clearly bad for stocks all round. In really bad recessions, you get a 50 to 60% decline in stocks peak to trough. So that's a long way down now, especially for the US, but also still for the UK. And potentially you can go even lower than that. If you think of the 1930s, the US market was down 90%. So potentially very bad outcomes. Just a quick word on valuations. Away from the US, valuations, of course, are better than they were last December. Obviously, the outlook is more difficult. Nevertheless, for the long-term investor, this is potentially an opportunity. And if we compare where the current levels are with bubble peaks, I think it's clear that these valuations are quite attractive, just taking a very long-term view. But obviously, depending on the scenarios in the next 12 months or so, we could still go down again first. So, my conclusions. First of all, the investment outcome is going to depend very much on COVID, no real surprise there, but also on political developments, and that's very important to watch. Overall, we tend to an optimistic view. We think that COVID will be tamed, a vaccine or treatments will come along in the next 6 to 9 months, and the economy will pick up. It could be a patchy recovery, and we still leave about a 40% chance that actually COVID is not tamed and things are rough for a very long time. So portfolios need to take account of those bad scenarios too. Quality and diversification going to remain critical. So that has to be built into portfolios. So if you want more details, look at our quarterly publication, Economics for Investment. There's full analysis of all the major economic regions. There's a full discussion of these scenarios. And there's also a special focus on the inflation-deflation issue. Thank you very much.